Good afternoon, everyone. On behalf of Cleanearth Africa, I warmly welcome you to today's webinar on preparing for IFRS S1 and IFRS S2, what it means for businesses. My name is Gerald Obobi, and I'll be moderating today's session. Before we move on, I'd like us to officially open this session by listening to a brief from our CEO.
Welcome to Cleanearth. My name is Eko Archer and I'm the Chief Executive Officer over here. I'm excited about the work we're doing for industrial clients and the impact we're making on society. In the last 2.5 years, we have evolved from the business that started some 27 years ago. Today, we're truly a clean technology company and delivering a lot of services around sustainability and the environment. Whether you have needs around water, clean energy, ESG, or broadly the environment, we are the one-stop shop that you can come to get those issues addressed. We're excited about the team we have put in place, strong diversity, a lot of women over here leading a lot of projects, and a lot of individuals who have come out of universities and colleges right here in Ghana and bringing services that are world-class that can be found anywhere on the continent. What we want to see is that our clients, first of all, are sustainable, they're doing a responsible production, and more importantly, they are profitable. So I invite you to visit our website, www.cleanearth.africa. You can find our email and our contact telephone numbers on there or anywhere on the internet. Thank you very much, and I invite you to be part of the work that Cleanearth is doing, which is improving the quality of life and safeguarding the planet.
Thank you very much. Thank you to our CEO, Mr. Eko Archer. Once again, you're all welcome to today's webinar. Today's conversation is designed to help businesses understand what these standards mean in practice. That's the IFRS S1 and S2, why they matter now, and what implementation may look like, and also what organizations can begin doing today to prepare towards these standards. Our first speaker is in the person of Oscar Obonyo, and Oscar would be speaking to us, setting the context, setting the grounds for us. And his section would be on the introduction to IFRS S1 and S2 and the need for sustainability disclosures. Before Oscar comes on, you'd realize that the audio and video buttons have been deactivated, but at the time for questions and answers, that will be activated. We have a Q&A section up on your screen. You can put any question that comes to mind over there so that during the period where we are asking questions that can be read, it can also be answered in the course of the session. So I'll just give a brief about Oscar, and then whilst he sets up his presentation and prepares to take us through. So Oscar is a circular economy and climate advocate with extensive experience in ESG, corporate sustainability, and climate conscious business transformation across East Africa. His work has influenced sustainability policies and projects across Kenya, Uganda, Tanzania, Somalia, Ethiopia, and Sudan. And beyond his professional work, he also uses music and literature as creative tools to advocate for environmental responsibility and social impact. Oscar, if you are ready, the floor is yours.
Thank you, Gerald.
You're welcome, Oscar.
I hope I'm audible.
Very audible.
Good. So as introduced, my name is Oscar Obonyo, and I have been in the ESG and sustainability space for around a decade now, spanning across sectors, and most recently into retail. So I'm going to be taking you through the first session, and basically this will be introducing you to IFRS S1 and S2. So I'm going to try to be as lucid as possible so that we all get a clear understanding of what this framework is all about. So to kick us off, if you want to understand IFRS, first you'll have to go back into 1973, whereby a group of private accounting firms from 10 markets came together to form the International Accounting Standards Committee. And this was intended to regularize the financial reporting landscape because there was a lot of fragmentation at that particular time. So from 1973, 28 years down the line, as much as they had tried to align these standards and processes, there still was a huge gap in terms of adoption. And therefore, in 2001, March 2001, the IFRS Foundation was founded. And immediately it was founded, the IASC was restructured to IASB, which is the International Accounting Standards Board. And the main mandate of this board became to generate all standards relating to international financial reporting. Down to 2005, the European Union issued a directive that all listed companies or companies working within the EU ecosystem were all required to compulsorily adopt IFRS reporting while preparing their consolidated financial reports. And this is what kick-started that harmony across Europe and also to the initial 10 markets that had put out the IASC. Now, because the performance was great with the IFRS and in terms of financial accounting, there was, of course, a global comparability of reports across different sectors, and therefore we would get harmonized results when you do comparative assessments. But then there was still a big gap in terms of corporate reporting. And that meant that because there were numerous frameworks out there that businesses used to do their sustainability reports, it means that that fragmentation was still causing a major challenge in that space. So in 2021, during the COP26 in Glasgow, IFRS decided to form the ISSB, which is the International Sustainability Standards Board. So this board, in essence, was formed to work independently, but in tandem with IASB, because IASB was largely on financial accounting. ISSB was now going to be the board that generates the IFRS Sustainability Disclosure Standards, or what we call the ISSB standards. And we can move on to the next slide. When you look at the history of ISSB, when it was founded in 2021, of course, the first set of standards that were put out were the S1 and the S2. And this was at a draft stage. And so they wanted to just look at how the ecosystem would appreciate this, because as I had said, there were lots of corporate reporting standards out there, and they needed to find something that would be well balanced and more material for cross-sector businesses. And therefore, there was whole period of public participation between 2022 all the way to 2023. And once the draft had been made and the public participations and engagements done and ratifications done, ISSB finally promulgated the IFRS S1 and S2 standards. But then, because now we are looking at a transition period, it wasn't going to be very feasible for businesses to uptake these standards on the go, and therefore a transition implementation group had to be formed to help businesses acclimatize to it and then open up a window for voluntary uptake of these standards. So that window will effectively begin from year 2024. Next slide, please. Now, looking at the S1 and S2, it was not a reinvention of the wheel because lots of businesses and organizations, even however varied within the same sector or different sectors, were using different accounting standards to undertake their non-financial disclosures. So IFRS basically came in and adopted a multitude of those standards that were in the market, including TCFD and TNFD from the Task Force on Climate and Nature-Related Financial Disclosures. So that was collapsed and then absorbed into the IFRS. And then the Sustainability Accounting Standards Board, the standards from ISSB were also adopted into IFRS. The CDSB also adopted to form what would now become the financial disclosures, sustainability-related financial disclosures under the IFRS. So for the Global Reporting Initiative, is a bit different. Of course, that was not entirely absorbed into the IFRS because it has a different structure from which that companies need to adopt to do their non-financial disclosures. And therefore, instead of that full absorption, GRI implemented what we call an interoperability agreement. And therefore, when you're doing a GRI report, by and large, it will be balanced with your IFRS S1 and S2. Now, for businesses that are operating maybe within the proximity of the EU ecosystem, you'll realize that even for the GRI reporting, it has morphed into the CSRD, which of course gives the same provisions but still remains in harmony with the IFRS. To the next slide, please. So IFRS S1 and S2, what are they? The S1 basically was meant to become financial disclosure branch that will focus on sustainability risks and opportunities that affect the business's balance sheet. And this was grounded on 4 pillars. Number 1, governance. So it means that while reporting, you need to demonstrate that the business has a proper setup process, starting from the board of directors, all the way to senior management, all the way to the regular workforce, all the way to policies, responsible business conduct, ethics and anti-corruption, and make sure that this system is able to identify these risks and opportunities early enough and relate them to your financials. Then it will come out to promulgating your strategy within that reporting. And then that strategy now needs not only to be exclusively financial, it needs to acknowledge these risks that your governance body needs to manage. Once you have identified the risks, then you have to indicate that those that were proven to be material enough to affect your financial performance are properly mitigated. And once you are able to demonstrate that you're able to mitigate it, of course, S1 will require you to use balanced metrics so that we are not using the initial metrics that were used in the ISSB, in the TCFD, that is disagreeable from those that are used in the GRI. So it means that regardless of which sector a business operates in, or even if the businesses are diversified but operating in the same sector, you are really able to compare performance because they are all using the same sets of metrics under this reporting wing. As we move on to S2, S2 is basically climate-related disclosures. That means that what are the prevailing climatic conditions and what are the transitional risks? You'll find that perhaps a business will be abstracting water that it uses primarily as an important raw material input. And then there are a series of subsidiary businesses or competitor businesses or peer businesses that are operating within the same ecosystem and abstracting the same water. So one thing that you'd look at as a potential significant risk is that if the abstraction exceeds what is required for you to take out of that ecosystem, the place might end up experiencing water stress. If there is water stress, it means that your raw input material is significantly impacted, therefore it impacts your production. So if you are able to look at that beforehand, what measures are you putting in place to mitigate it, because that is going to become a potential negative effect to your operations and ultimately to your balance sheets. There's also the poster child for sustainability, which is the greenhouse gases. And of course, under S2, during the transition or the initial adoption period, IFRS requires you to report on the scope 1 and scope 2 of your greenhouse gas emissions, but then progressively take up scope 3, which are emissions within your value chain, so that you are able to have a holistic outlook of business portfolio emissions. Because if you look at a lot of businesses, especially in the hard to abate sectors, forestry, agriculture, land, mining, manufacturing, these significantly contribute towards the portfolio emissions, about 70 to 80%. And therefore, while disclosing under S2, it means that you need to have as much data. There needs to be significant data rigor so that you are able to at least disclose what is almost a perfect reflection of your business externalities. I did a comparative analysis of the adoption timelines, of course, between Kenya and Ghana, but across Africa, this would largely be looking the same. And as we can see that ISSB had put voluntary adoption of S1 and S2 between January 2024 and 2026. And so all organizations that wanted to take it up on a voluntary basis and just try and understand what the reporting structure and pathways look like, that was the significant period, and it ends this year. But then from January next year, that means that in Ghana, for example, all the significant public interest entities will need to comply with the S1 and S2 requirements. If you look at it comparatively with Kenya, it's still the same public interest entities. And then from 2028 in Ghana, all now non-public interest entities, but which are large corporations, will now need to join the game. In Kenya, you find it stratified that so that 2028, the large private entities join in, and then in 2029, the micro, small, and medium enterprises take it in. And then in the last phase of it will be government organizations and NGOs, and of course, depending on the accounting authority or accounting professional body within the country, those are the ones that they reserve the discretion to determine the dates for adoption for these entities. So, for example, Ghana, the ICAG will do it, and then for Kenya, we wait for ISPAC to make those pronouncements. But then now you'd ask yourself, so what's the significance or relevance of having to disclose all this, especially with the newly adopted S1 and S2 standards? Well, just like any sustainability disclosure standards, the S1 and S2 speaks to the investor. And that is the overarching function of the IFRS standards, because it is what we call a single materiality standard. So it mostly speaks on how sustainability and climate risks and opportunities affect your balance sheet. So if you are able to explain this to the investor in confidence that this is what we've mapped out as our risks, and this is the mitigation pathway that we are laying out for enterprise, so that we are able to stay ahead of these risks, then our business becomes one that can survive. Then the investor becomes more confident that you have actually de-risked your business. Secondly, general adoption of these standards enables that, just synonymous to what IFRS did in the financial accounting space, the S1 and S2 is supposed to do the same now in the sustainability space, so that all reports that are prepared under these standards, regardless of which part of the globe or the continent the business is operating in, the impacts can be assessed and compared on a neutral platform. The standards will also help businesses that have not yet begun, because you'll notice that a lot of SMEs are not very keen on undertaking their sustainability reports. And even when they are doing their usual financials, most of the risks and opportunities are not tied to issues of climate and sustainability. So it enables you to look at your risk profile in a broader way from the traditional way, and helps you shield yourself from what we've traditionally been calling acts of God, things that before time we thought that we could not control, even with our usual professional scoping capabilities. And then lastly, of course, the enterprise value, which means that are you able to run your business in a way that it survives the climatic shocks and the environmental shocks, the social shocks that emanate from fast changing times? So if you are able to interpret scientific data and then set scientific targets and then put in proper mitigation measures for this, it means that you're staying ahead of the curve, and therefore your business remains to become sustainable. And that is why disclosures are necessary, not only for your investors or your stakeholders. It also helps you set a benchmark for you to know if you are actually progressing, if there are actually risks that remain outstanding over the years that could prove to be a problem in the long term. And once you're able to understand this, it means that you remain proactive in keeping your business awake, even with these unforeseen risks. Thank you.
Thank you very much, Oscar. This was indeed spot on and well delivered. A key takeaway from your presentation is that IFRS S1 and S2 are part of a major global shift towards consistent and investor-focused sustainability disclosures. And businesses have a real opportunity to begin preparing ahead of the wider adoption. And like you mentioned, it's not just for the investor, but also for businesses to be able to track and monitor what risks exist and how they tackle those risks. Thank you very much. And this gives us a strong foundation to move deeper into the IFRS S1, specifically what sustainability-related financial disclosures look like in practice for organizations. But before we move to the next speaker, we would like to take a brief pause as we transition. And I have a question for all of us gathered here. And the question, okay, there's a poll up there. What one word comes to your mind when you think about sustainability risk? You just want to type a word and submit, and we all take a look at what interesting words comes to our minds. I see 2 responses. Let's all take just 1 second, 2 seconds to type in a word. When you hear sustainability risk, what's that one word that comes to your mind? Great. So just so those who are not probably on the road and are not able to see what's going on here, we have accountability, water resilience, just mentioning a few: poverty, data exposure, climate resilience, and these are just but a few. Thank you very much, technical team. We'll move on to our next speaker, and this person is in the person of Ernest Akompe Jamina. And Ernest is the founder and lead consultant at Dale Consult. He's a chartered accountant and ESG professional with over 10 years of experience in business consulting and advisory, sustainability advisory. He is passionate about helping organizations align profitably with sustainability while meeting evolving regulatory and stakeholder expectations. Over the years, he has trained professionals and advised firms on sustainability strategy implementation across multiple industries. Ernest, if you are here, I'd like to welcome you to delve deeper with us on the road to IFRS S1.
All right, thank you, Gerald. I hope you can hear me.
Yes, I can hear you, Ernest. I
And
can see you too.
permission to turn off my camera if that is okay.
Okay,
At least,
that's
yes,
fine.
seeing
We've
me.
seen,
Yeah.
great.
All right, so good afternoon to you, ladies and gentlemen. Just as we heard, my name is Ernest Akompe Jamina. And over the years, we've been helping organizations to delve deeper in how to implement ESG practices to become more sustainable towards the future. Just as we heard from the first speaker, the IFRS S1 has come to stay. Whether we like it or not, it has come to stay, just as we have the other accounting standards that have come to stay, and that is shaping the accounting profession in the space. The same way the IFRS S1 S2 and the other standards on sustainability have also come to stay to make sure that we become very responsible towards the environment and society in our operations as businesses. So we have the IFRS S1, which has the name General Requirement for Disclosure of Sustainability-Related Financial Information. And this particular standard was actually designed with these objectives. The first of it, to help organizations to be able to disclose information on their sustainability-related risks and potential opportunities. It also stands to help organizations to know what they stand for, to have a link between themselves and their stakeholders, as well as the natural environment, and even through their value chain. So the S1 creates that connection between organizations not seeing the environment, their stakeholders, and their value chain as distinct from their operations. Equally, the S1 stands to help organizations to understand how sustainability risk and opportunities affect their finances in terms of their cash flow status, their performance, as well as the cost of capital and their activities over the short, the medium, and the long term. That is why in most cases, when you ask individuals or people about how or what sustainability is, almost everyone will tell you that sustainability is looking at satisfying present needs without compromising the needs of future generations. In that case, it means that we need to have standards that is actually going to operate or regulate organizations to work towards future generational needs and not just the present needs. And equally, the standard prescribes how reporting should be made. When it comes to reporting on sustainability issues, the standard gives us details on how to report on sustainability issues. Looking at the scope of the standard, you can go to the next slide, please. Yes, the standard is actually established to give us or help organizations to report on their sustainability related financial disclosures. You might have known that in preparing financial reports, we have the non-financial aspects where we have the management commentary, the risk report, and other reports. And mostly, some people classify sustainability reports also under the non-financial reports. But the S1 is helping us to see that we need to recognize that although we are trying to perform some activities, we still need finances to get them done. And for that matter, those finances or any finance we invest into reasonable or sustainable activities need to be reported on. And that is why we need to look at the financial aspects of our sustainability issues. Therefore, the need for the IFRS S1. If we have any risks or opportunities that could not reasonably be expected to affect the entity's prospects, then we ignore those issues. It means that any risk or any opportunity we see to be exposed to needs to be reported on as long as the entity intends to invest or put some funds into those activities. Like any other accounting standard, the IFRS S1 is built on some conceptual frameworks. You know that for us to say that a particular accounting standard is unique, or let me say for us to say that a financial report is good enough, it has to possess some reasonable qualities. And in all cases, we expect that financial reports are relevant. When we say relevance, what does it mean? The whole information we need is that the content of the financial report should be able to influence the decisions of the users of that particular report. Therefore, if we are to prepare any sustainability reports, then the information contained in that report should be able to influence the decision of the users. To be relevant, we expect the financial report to have two features. That is, it has to get what we call confirmatory values as well as what we call predictive values. When we say confirmatory values, all that we mean is that because of its relevance, because it is able to influence decision, then we should have evidences to the fact that these activities actually occurred from its onset to when any finance was released towards that particular activity. So we should have the confirmation that activities were actually undertaken. Then the predictive value indicates that the report should be able to help the users to make predictions into the future, to make decisions that is going to affect the future prospects of the organization. So basically, we expect financial reports, especially those centered on sustainability reports using the IFRS S1 to meet this particular frame foundation. The next is about being faithfully represented. And faithful representation is basically looking at we having an information that is complete, that is neutral, and that is accurate or free from any error. So we need not withhold any relevant information when preparing the financial reports on IFRS S1 or using the IFRS S1. In that case, every activity that is undertaken should be exposed or should be indicated or disclosed in our report as presented. Aside these two relevant features of financial reports, we expect that the sustainability report should equally be comparable. That is, we should have some features to help us compare what is happening over the years, equally the entity's operations to the industry in which it operates, as well as the entity's operations against its competitors, if there is. Then the information should equally be verifiable. It should also be presented on time. That is, we should have the information on timely basis. And as we know, financial reports are mostly prepared annually. Therefore, sustainability reports being embedded into our financial reports should also be prepared annually as such. But we would look at other features of it where management or the board may require that we should have some frequent information on our sustainability issues. And another feature we'll talk about is that any report we prepare, especially for sustainability reports, should be understandable, meaning the users of the particular report should be able to understand the content of it and also relate to the information in there to see how it relates to their activities. we know that the IFRS S1 is basically an investor-focused standard. Therefore, it has to meet the needs of our investors. Aside these general foundations or conceptual foundations, we expect that the IFRS S1 indicates that we should have some key conceptual foundations for this particular standard. And the key conceptual foundations, we have fair presentation, we have materiality, we have the reporting entity, as well as connected information. Let's take our time to look at how these conceptual foundations relate to the standard. If we take fair presentation, yes, if we take fair presentation, all that we want to say is that just as we have faithful representation, likewise, for us to have a fair representation of our sustainability report, then we should have something that is complete, that is neutral, that is accurate, and it should depict the related risks and opportunities that we are prone to as an entity. Moreover, we expect that the report should be able to affect the cash flow of the organization, as well as to help us see interactions between the stakeholders, the society, and the community. So to have a fair representation, every aspect of our financials when it comes to sustainability issues should be reported on, so that we see how we are investing or putting our financials into reasonable and relevant activities. When we talk about materiality, which is the second framework, we are looking at a situation where we should have information that is indeed able to influence the decisions of the users. We say an information is material if it has the prospect to either alter the decisions of users. So we should be able to identify key or relevant issues pertaining to the particular entity in question. And one way to identify material issues is to do what we call the materiality mapping. Sometimes you can look at your KPIs as an entity, segregating your KPIs into the environmental issues, your social issues, and your governance issues. And when you segregate them, you look at your stakeholders and you make a mapping. You do that mapping to determine what issues relate to the particular entity and what issues your stakeholders are interested in, so that you know the information that is needed enough for the organization to report on. And once you are to report on such information or such needs, it means that you are equally going to implement those KPIs to ensure that you achieve what you expect in their sustainability activities. When it comes to reporting entity, it is just about the entity in question that is preparing the financial information. And for that matter, if it should be, let's say, Anglo Gold Ashanti in Ghana, then it is the reporting entity we're talking about. Then the last feature or the last conceptual framework for the IFRS S1 is connected information. And this one is looking at we having a connection between the sustainability related risk and opportunities. That is, we should see a relationship between the risks we are claiming to be exposed to, as well as opportunities that are available for us as an entity. We should equally see a connection within the various pillars of the IFRS S1. You know, the IFRS S1 has 4 pillars. That is governance, strategy, risk management, metrics, and targets. The report will help us to see the connection between these particular pillars. And finally, it is also going to help us to understand the relationship that happens across the sustainability related financial disclosures and the general purpose financial information we have prepared. So when it comes to the connected information, it means that the sustainability report we have prepared should not be distinct from the entity's financial report. It should equally not be distinct from our strategy, our risk management issues, and equally, we should have a link between the risk and opportunities for this particular report. Now, let's look at the key content areas where we need to report on using the IFRS S1. The standard tells us to report across 4 sections or 4 areas, basically on governance issues, on our strategy, risk management, metrics, and targets. When we pick the governance issues, what are we looking at? You know what governance is, right? We are looking at the processes, the controls, the procedures, as well as the ways the entity implements to monitor and manage their sustainability related risks and opportunities. And with this, we have to know the structure we are going to use. Probably, and as we know, it is always the responsibility of the board to be responsible for sustainability issues. And the board mostly works through various committees. I would always say that from what we have from the corporate governance code, I always know that the risk committee is mostly the best to handle sustainability issues when it comes to implementation of sustainability issues in every organization. And once we know that the board is responsible, or the overall head to be responsible for sustainability issues, working through various committees, these committees would actually and practically also get sustainability issues happening across any areas of the organization through individuals. And we should know the hierarchy in terms of who to report to, the number of times reports should be presented, as well as any performance to know how we are actually doing with our governance structures. Equally, how we are even going to monitor our sustainability activities in the space or in the entity equally captured under the governance. When it comes to the strategy is basically looking at the effect of the risk and opportunities on the organization's prospects, equally on the business model, as well as the value chain of the organization, even how the various activities affect our decisions, as well as how sustainability risk and opportunities affect our financials in terms of our cash flow, our financial performance, and even for the financial position. That is affecting the medium term, the short term, and the long term prospects of the organization in question. And equally, the strategy equally looks at how resilient our model is when it comes to sustainability related risk and opportunities we have in the space. Risk management looks at the strategies we are putting in place to identify the risks we are exposed to, how we even assess these risks, how we prioritize them, and how we monitor the risks we are exposed to as an organization. So we take our time to analyze, we take our time to assess it, and even the likelihood and the magnitude of the effect of any risk we can be exposed to is handled under risk management. And finally, when it comes to metrics and targets, that is where we identify our KPIs, measure the KPIs, and see how they affect our business activities. So with metrics and targets, it is always advisable, as we heard from the first presentation, when it comes to the IFRS S1, we have the opportunity to look at issues in the ISSB standard. You can equally borrow some issues from the CDSB, and you can even look at the GRI framework to take up some key issues which can be reported on when it comes to your metrics and targets. If you pick something like the ISSB standard, as we know, cuts across 11 sectors, and these 11 sectors cover 77 industries. In that case, we're able to know the very KPIs you can report on so that you know what is relevant enough for the organization and even how to measure all these things. We have them contained in the ISSB standard. In a situation where the IFRS standard does not give us specific metrics on and how to measure them, it gives organizations the opportunity to use judgment when it comes to selecting their KPIs or their metrics and the targets they want to set. And in applying judgment in this case, we have to ensure that we get information that is relevant. And we've discussed relevance already. And the same way, the information should present fairly what we stand for as an organization. So when we have to use our own judgment in such instances, that is what happens in that space. We can go to the next slide, please. Yes, so I think we have some details here about what information we report on, and in the governance here, we report on the board oversight of sustainability related risk and opportunities. We have the role management also performs, and even when it comes to individuals who have been assigned responsibilities, we equally report on that. The number of times we need to receive reports, as well as who should report to who. The structure for the governance system is also equally mentioned here. And as we have discussed on strategy, we are looking at our risks and opportunities that could affect our prospect as a business, how it's going to affect our business model. So mostly our way of managing the risks and opportunities we have as a business. The next slide will highlight on the risk management and the metrics and targets as we've discussed already. And I think the next one should also tell us about the source of guidance. Just as I mentioned the various frameworks we can equally look at when it comes to the metrics and targets. So we can look at the SASB, we can look at the GRI, we can take or borrow from the CDSB. As it stands now, the IFRS S1, as we heard, has implemented or embedded the SASB and some portions of the CDSB into the IFRS S1 and S2. So when it comes to the S1, we can look at what we have in the SASB to determine our key issues and even how to report on these issues. And that is very fantastic if we delve deeper into those factors. As we are discussing, someone may be asking, we've been mentioning sustainability risk and opportunities. What are some of these risks and opportunities? So these risks and opportunities are factors that can affect the entity's cash flow and the access to finance, as well as the cost of capital of the entity. And these effects or these factors cut across the three segments, being the E, S, and G, environmental, social, and governance issues. And if you look at what you see on the screen, we have the risk factors and the environmental issues, and the opportunities we can talk about and the environmental issues. For environmental risk, we have climate change, we have regulatory risk, we have pollution and waste, and other issues. For the opportunities, we can look at renewable energy, energy efficiency, green products, and even the carbon market, which has also become a good area for organizations today. For social risk, we can talk about labor issues, human rights violations, conflicts, that's community conflicts. And when it comes to the opportunities, we can talk about employee development, diversity, equity and inclusion, community engagement, as well as the trust our customers should have for us. And for the governance risk too, we have the governance risk and opportunities where we have weak internal controls as part of the risk, poor oversight, cybersecurity risk, or as part of the risk we can be exposed to. And we have the opportunities as well. Note that all these risks and these opportunities present a situation that can affect the finances of the organization. That is why it is always relevant to identify what is pertaining to the organization so that you can actually report on what should be reported on to indicate how responsible we are as an entity. So let's look at some two industries, possibly the mining and the financial industry. And these are key issues that relate to these two industries in this space. For the mining industry, environmental degradation is a very key issue there. Climate transition, water usage, community engagement, as well as occupational health and safety. These are key issues to the mining sectors. And when you come to the financial sector, they are also responsible, equally giving attention to responsible investment policies, ESG lending. That is, they want to see that if they are to give financial assistance to entities or individuals, they are going to use them for sustainable projects or activities. And equally, many financial institutions have come up with green financing. So, in effect, the framework, the IFRS S1, is setting up this opportunity for organizations to be very responsible when it comes to the society as well as the environment. What do you think are some of the benefits for adopting this standard? To the companies, our governance structures will be improved. There is going to be better risk management system. We'll be able to assess sustainable finance as well as enhance our reputation, and we also build the confidence of our investors. And to the investors, they'll be able to make better decisions where to invest their funds. And equally, they will have reliable ESG information. This framework actually is there to solve some challenges we can see presented in the sustainability framework. You know that in most cases, and as the space was evolving, the challenge of we having a particular framework that is going to regulate the whole space became a challenge. Many companies invested in CSR issues or CSR activities such that they will be responsible towards society. But this standard has come to help streamline the whole activities and help us have the space operating effectively. What are some of the challenges we can talk about? The next slide tells us that we currently have lack of expertise. Oh, I forgot to bring the F. Sorry for that. So We lack so much expertise in this space as it stands now. And we expect professionals to equip themselves so much so that they can meet the needs of the framework, as well as helping organizations to become very responsible. Weak internal controls also exist, especially with many SMEs, where people take decisions without considering so many factors, where people want to make decisions as if they are running organizations as their pocket structure. And so internal controls become a problem. And for that matter, it even becomes a problem to gather data when it comes to sustainability reporting. Equally, we have the problem with limited reporting systems as well as regulatory uncertainties. So these are some challenges, and it is good the IFRS S1 being the general overview for reporting the sustainability related information is going to help us, or has come to help us address some of these challenges. If we intend to implement the IFRS S1, how do we go about it? As an organization, you first need to determine the readiness, how ready you are, and you have to conduct a sustainability gap assessment. So know how ready you are, know where you stand, know what is actually happening now. And then you look at your governance structures, know how you're going to structure your sustainability or issues. Once you have your governance structure, develop an ESG data system so that you put all your relevant activities that are being undertaken into your ESG data system. And from this data system, you're able to identify your key KPIs and you map them to know your exposed risk and opportunities. Then you can be able to clearly define your metrics and the targets you want to set for yourself. Equally, you'll be able to develop strategies so that you can implement or integrate the ESG systems into your risk management activities as well as organization's operations. Then you can then go ahead after implementation to report on it. And equally, we need to have an assurance from our auditors, sustainability auditors, to see that indeed we have become very responsible as we are claiming to do. And what roles can we perform as professionals in this space? We can equip our knowledge in ESG data validation or verification. So you can equip your knowledge in this area. You can equally equip your knowledge in ESG or sustainability reporting, internal controls, risk assessment, assurances, giving assurance, as well as helping organizations to be compliant and to monitor their activities. Once you're able to equip yourselves or ourselves with such knowledge, we will be able to help organizations to become very responsible towards the environment and towards society. And indeed, in the near future, we can say that we contributed and our mark we are living today will help future generations. Thank you.
Thank you very much, Ernest. That's very insightful. Yes, I can see some hands clapping. That shows how much people have absorbed and the depth to which you have taken us. In our Q&A section, we have some questions there just to engage each and every one of us. I know we are all professionals in our own standing, and we also have ideas on the subject matter. We just want to know our thoughts, and so kindly click on the Q&A button on the top of your screen and engage with the questions that are up there. Want to know your opinion, why IFRS S1 or S2 matters, if sustainability reports should be prepared frequently than annually. I mean, there are others. What other risks and opportunities are worth mentioning? Just engage with the questions in the Q&A section. And thank you very much once again, Ernest, for that insight you have shared with us. Now we have learned that IFRS S1 is really asking businesses to move beyond sustainability commitments and begin embedding sustainability risk and opportunities into governance, strategy, risk management, and decision making. You have shared a lot with us, and as we engage with the questions in the Q&A section, we'll be preparing for our next speaker, Eugene Elom Adraku. And Eugene would lead us to also walk the path of IFRS S2 and share his insights in that area as well. Eugene is a chartered environmentalist and a highly distinguished environmental sustainability professional with over 12 years of experience delivering environmental and social safeguards, ESG advisory, and impact assessment services across various sectors, including infrastructure, energy, climate, and digital development sectors. And he has built a strong reputation for supporting both public and private sector institutions and development partners to integrate environmental sustainability, climate resilience, and social risk management into major development programs and investments. So at this point, we'll hear from Eugene as he takes us through IFRS S2.
Thank
Eugene,
you very much. Yes, good afternoon, everyone. I hope you can hear me.
Good afternoon, Eugene. I can hear you clearly.
Excellent. Thank you very much to Cleanearth for the invitation, and thank you all for joining today's session. So, and before I start, thank you to Oscar for laying a very important foundation on IFRS, the introduction to it, and then for Ernest as well. That was a very deep dive into IFRS 1. Having laid that foundation, my focus specifically is on IFRS 2, which deals with climate-related disclosures. I'll keep the discussions very brief, practical, and then business-oriented, because what we want to understand is especially how the standard means for businesses, for boards, managers, investors, and institutions as we all prepare for climate-related financial reporting, considering the importance that is gaining in the field now. So for me, my key message I want to take away from this, everyone to take away from this, is that climate disclosure, okay, it's no longer just basically an environmental or CSR issue, but so we understand the fact that we have transitioned from climate disclosure being a CSR-oriented one to basically a financial reporting, a governance, risk management, and business strategy. So having laid that foundation, I'll say we can, yes, thank you very much. I see that you're already on slide 1, which is the introduction. So like I said, climate disclosure has changed strategically over the years. So previously, many companies were reporting and then treating climate reporting as voluntary sustainability reporting of a sort, you understand? But today that has fundamentally changed, as Oscar and then Ernest both have said. So this means that now businesses are basically expected to explain not only what they are doing about climate change, okay, but how climate change is impacting or affecting their finances, operations, risks. So IFRS 2 is basically expecting that companies are not only simply saying that we care about climate change like CSR would expect, but now we are asking that the companies are expected to tell us exactly how climate-related risks and opportunities could affect their enterprise value. So please, we can move to the next slide. With that having been said, I believe that Oscar and Ernest laid some good foundation on. We can move to, this is an infographics on the transitioning, so we can move, yes, to the IFRS 2. So one would ask, the foundation has been said, so without belaboring the point so much, IFRS 2, like was established by my previous colleagues, is a climate-related disclosure standard by the ISSB, which is the International Sustainability Standards Board. Okay, the purpose is to basically create a single global baseline for climate-related financial disclosures. And this is important, just like Oscar said, because historically, companies were reporting climate information in different ways, different frameworks. Throughout the years, we've had fragmented natures that people are reporting. So what the IFRS S2, the standard 2, basically seeks to do is to create a streamlined approach, okay, so that it improves across 3 main things. So it helps to breed consistency, compatibility, and then transparency, so that we have one framework that all companies are reporting to. And for me, anytime I go into conversations about climate-related disclosure, the most important thing that I find that the standard 2 of ISRS is that it is connecting climate-related risks and opportunities to financial performance. Like we have established previously that the traction of businesses cannot be had without conversations around climate. So companies must begin to explain how climate change is affecting their revenue, their costs, their liabilities, capital expenditure, insurance, and even long-term business resilience as climate change and its impacts is evolving. So that is a foundation about what exactly IFRS 2, that's climate-related financial disclosures. So we'll move into the next slide, which I believe is talking about the four core pillars of IFRS 2. That's, yes, thank you very much. That's governance strategy, the risk management, and then the metrics and targets. So just to lay a little bit of emphasis on the governance ask. So basically the question is, we're asking a question that who is responsible for climate issues within the organization? Who is taking up the responsibility? Because we are moving from, no, please, I think we have moved too fast. Can we kindly go back to the, yes, excellent. Thank you very much. So the questions we are asking is that who is responsible for climate issues, okay, at the boardroom level within the organization? Is it the board? Is management accountable? That is what IFRS 2 has as a core pillar. The first one is that we are moving from just a departmental responsibility where you go into any institution and then you have climate-related responsibilities drop down on an environmental sustainability unit, but IFRS 2 is seeking to bring some ownership of a sort. And then what is the strategy? So the question is, how do climate risk and opportunities affect the business model, okay, in terms of strategy, investment decisions, long-term planning, and even business sustainability as well? The risk management aspect of IFRS 2 is basically to identify, assess, and then prioritize any emerging climate-related risks and how the company is seeking to manage them as a third pillar. Then the fourth one, I believe Ernest even spoke about, is the metrics and then the target. So in this case, we are asking how is data being sourced and what are we including greenhouse gas emissions, targets, performance indicators, and other climate-related metrics in business consideration. So these are the four core pillars of IFRS 2. So like I said, if you appreciate the four core pillars, you realize that IFRS 2 is no longer about just reporting, where we have previously people coming out with reports trying to show some compliance of a sort. It is really a decision about whether climate considerations are embedded into business decision-making, especially the first pillar, which is basically putting so much pressure and burden and responsibility, for want of a better word in saying, on the boardroom level. So yes, we can move to the next slide. I think we're going to talk about the climate disclosure, why climate disclosure matters, like I said. So basically, climate change, we know, is affecting businesses in very practicable ways. I'll give an example. In the agric sector, you see that rain variability can reduce crop yields and then also increase the cost of irrigation and alternative sourcing. So when you come into a Ghanaian context now, you realize something interesting happened this year where because we have all known that at the onset of the month of January, when we are moving into the new year, you would expect our dry winds from the Saharan desert to come, which we call the Harmattan periods. You notice that down south this year, I was up north in the period. So as usual, because it's the temperature, it's the climatic condition there, we had some hazy winds there. But down south, you realize that we missed out on that in this particular year. And all of these are some of the impacts of climate change as we would have them. And when you talk about even the rains, currently we are moving into the rainy season, or we have gotten into it as you would. Lately, you are not able to predict when the rainy season will really start or end, because if you remember, as early as March or even in February, we had some spots and showers of rains. And what this does is that for businesses which are dependent on, so much of rains, like giving an example, cocoa, grains, and other agricultural inputs, because it's a direct supply chain and revenue issue, you find that such impacts become more for these places. When you go into the mining sector, which is increasingly has become topical in the Ghanaian context, water scarcity is affecting production because some communities, and then of course the community tension and increasing operational costs. I've seen a lot of businesses that are either being absorbed by other mining areas or others And these are huge. These ones are huge financial implications because you are not able to identify when production is stopping, how much of an impact that is having on higher capital expenditure and all of that. So, and then even in the logistics field, where we have a lot of moving of freights and all of that, flooding can disrupt routes. In the last few days, we have seen the unfortunate usual situation we have in Ghana, where we have some few millimeters or few hours of rains, and then the whole country is flooding. And beyond our regular commute to and from work, you have impacts to freight, because we're still in the first half of the year, and you have a lot of logistics movements in anticipation of the midpoint of the year, or even the last part of the year where we have the Christmas and a lot of festivities. There's a lot of movement in the logistics field around this time. That's how come you find a lot of trailers on the roads around this time in the country, because people are moving in and out. And then some of these things like the flooding is disrupting the supply chain. And then when our cost of goods go up, mostly people do not understand. And these are some of the direct and indirect effects and impacts that climate change has, okay, even beyond agri, the mining, production fields. It's recently that I got myself thinking about impacts even in the transition and then the logistics flows as well. So for me, like I'm saying, IFRS requires businesses to move from general climate statements, okay, to more specific analysis. It's no longer, is climate change a risk? That question has been rendered moot and has been answered over 50 years ago, and even more so in recent times. It is a risk. Now, the question is this: how much of a risk is it? How material is it? What are the financial implications? And what is management doing about it? This is basically what IFRS 2 is seeking to do. So please, we can move to the next slide, which is still talking about the climate valuation ecosystem and what regulators. Yes, please move to the next slide. Thank you. Yes, we've spoken about the water scarcity. So if you could move to the next slide. Please move one more step. Exactly. Thank you. So with the governance and strategy, remember we established the fact that the core pillars, among them is the governance, okay, the governance strategy and what it is expecting or what level of imposition it is having. So under IFRS 2, the S2, companies are expected to explain how climate-related issues are governed internally. So the board, we should, as part of some audits that we occasionally do or teams do, we should expect that you see boardroom meetings, minutes of meetings where the conversations are no longer only financial, okay? We should see that some oversight responsibility on climate-related issues and matters with clear responsibilities and roles, okay? So climate-related issues and how they are integrated into, let's say, enterprise risk management. For a long time, you would find that boardroom conversations are mostly limited to operational, financial, and then even risk. Yes, some of these are all risks, so governance, corruption, the fraud, and all those other risk factors. But the standard 2, okay, of IFRS is now placing that responsibility on the governance level. So I'll give an example. So if a company is exploring a major investment in infrastructure, so let's say some investors from whichever country looking to drop in some big amount of money. Under IFRS, the standard 2, the board and management should be asking a number of questions. Is this investment expected to lead to exposures of flooding, heat stress, water scarcity, let's say even some future carbon regulation, or whether they are changing market expectations? Okay, so the strategic question for an investment like this will be, how is climate change going to influence the organization's long-term business model in terms of this particular investment? And what are some of the investment decisions that can be taken to mitigate or to even shore up the business and protect the business from any such? So what the standard 2 of IFRS in this in the long term is looking at is pushing climate from the sustainability department, like I said, into the boardroom and then a financial function, because this is a disclosure, it's a willing and a willful disclosure, but then the board is expected and then management are expected to push the entire weight of the management around such disclosure. So when we look at climate-related risk, which is the next slide, if you can kindly move to that, you find that the standard 2 basically is looking at climate disclosure in two broad senses. I believe quite a number of us here maybe have that background. So just to give some overview, the financial risks, okay, have been spoken about in a lot of times. So now climate-related risks are mostly fiscal risks and then a transitional risk. So the fiscal risks are what we have seen. Like I mentioned, the flooding, the drought, heat waves, and extreme storms, okay, sea level rises. I'm sure in recent times, for those of us who keep track of news, you see that our coastal lines, okay, are really, really being depleted. I saw in the news a couple of months ago an expose of a sort, a coverage of a sort by TV3, where you have a whole coastal line in Keta and some about 12 communities having been displaced because of high sea level rises. The foundation beds of a lot of these beachline communities have been washed away, and these are things that have been happening over time. We report about them, people here, and then we move away from it. So the conversation is that all of these are fiscal risks that needs to be handled and then needs to be addressed. Then you have the transitional risks. Transitional risks, on the other hand, are basically risks that a company is exposed to by virtue of shifting from the high carbon economy to a low carbon economy. So basically, if a company is looking at moving into low carbon emissions, what are some of the regulations, carbon pricing, changing technologies that they will be exposed to? So among the key things that a business will be asking is to be able to identify some of these risks that they could be exposed to or contributing to as a result of they are moving. So let's say a bank. I'm sure a lot of us know that lately the Bank of Ghana in the last 5 to 6 years has come out with many regulations to regulate and then put some responsibilities on the bank. So you find that previously everybody would think that you are going to the World Bank or the IFC or development partners, and they have these environment and social frameworks and safeguard standards, and everybody wants to be running away from it. Now there is nowhere to run to, because even in the local context, you go to the banks, they're looking for some investment. The banks in Ghana are also requiring some of these things. So you see that a lot of banks have the ESG units, they have sustainable financing, they have climate risk disclosure, sustainability requirements for banks. And that is because, like we have said, without attempting to belabor the point, a lot of investments have gone down many years without thinking about the impacts that we are having on the environment and the environment is having on us. So a lot of banks now are not exposing their loan portfolio to investments without going through the some of these requirements that previously you would think that only the development partners would have. A lot of manufacturers are also doing the same thing. You go to some mining firms now, by virtue of water use. I have seen Newmont have some of the strictest, or just to cite them as an example, some of the strictest requirements for subcontractors in terms of ESG sustainability reporting. I've seen them use just a fleet forwarding company, and the requirements for them and reporting is just top notch, you understand, because all of these is to help basically consolidate the conversations around it and not limited to just the direct impacts. If we could move to the next slide. Basically, we want to look at, after having had conversations about the risk factors, what are some of the opportunities? Okay, so under IFRS 2, there is the standard 2. Conversations are not limited to only the risk as you would have it, because the opportunities are also diverse as much as possible. Because climate action also has opportunities in renewable energy. I've been in the space for some time in terms of renewable energy. So some energy efficient green products and services, sustainable financing, and then even the innovation space. For instance, a company that I did some consulting for were seeking to reduce energy consumption by lowering operational cost. Okay, so they developed a low carbon product, okay, to as much as possible get access to some new markets. Okay, so this is a company that has very strong climate governance, which would help them to attract these sustainability or sustainably inclined investors and then lenders. So the conversation around the IFRS standard 2 helps to also get businesses to identify, because once you have identified your risks, then you see what are the emerging opportunities or the existing ones to be able to take opportunity of some of these ones. So it helps businesses to basically move beyond treating climate disclosure as a strategic tool, like we have said, but rather as a reporting burden of a sort, because once you are putting such risks and then opportunities out there, you are assessing, self-assessing. These are voluntary and willful disclosures, but you are putting a company out there, and as much as possible, whatever it is that the company is reporting is as high up as the board level, like we have said. So it helps the business to gain value, from processes. The next slide, I believe, talks about the metrics and targets. I believe that my colleague Ernest spoke about it. So without going too deep into it, we classify under the IFRS 2 standard 2 the sources of emissions. The greenhouse gas emissions, I believe we all know, are the primary cause of the climate change as we have it. So companies are supposed to disclose the greenhouse gas emissions for things that they have. And then mostly you will find, I believe it was Oscar, and then possibly Ernest also spoke about it, the direct emissions like we have here, direct, indirect, and then the indirect from the value chain. And mostly you would find specialists talking about them and saying scope 1, scope 2, scope 3. So what the standard 2, the climate related disclosure, is expecting is that under metrics is previously you would have people report on carbon emissions or air quality standards without really looking at the greenhouse gas emissions. So one of the things that a lot of companies are really doing lately is that there are direct emissions from owned or controlled operations, which is what we call the scope 1. It refers to basically emissions from such usage. So you have a fuel that is used in the company's vehicles. We have to track that and then report on that. So from generators, from boilers, from industrial processes, all of these fall under the scope 1 emissions, which is mostly a little bit easy to navigate. The scope 2 are basically indirect emissions, which are greenhouse gas emissions, which are from purchased electricity. So if you have some electricity from the national grids that is coming in, tracking the emissions related to its usage, heating, cooling, or then the steam. I believe that it was, yes, Ernest who spoke about it, or then Oscar, one of them, that the indirect ones, which is the scope 3, which you would always find is one of the most difficult greenhouse gas emissions reporting for most people to do, because this is like I was talking about the Newmont situation. These are emissions that a company is supposed to track and metrics on based on the value chain. So these are mostly very challenging because a company or firms are supposed to track and report on indirect emissions from suppliers, from transport, from product use, from business travel. You have expatriates who are coming in, or boardroom flights in and out of town. You have people coming in indirectly to do some work, upstream and downstream activities. Scope 3 is it's a very complicated one to navigate. But it's just that the disclosure puts this responsibility on companies because, like I said, you can quietly manage your scope 1 and then your scope 2 emissions, and then say that you are doing well in terms of expectations for climate change. But then a lot of times we have seen that there is so much impact from the indirect activities. So basically, like I said about BOG, the banks, and then the banks are doing the same thing for the smaller banks, the credit unions and all of that. It's the same thing you have for mining industries, the oil and gas, the production field. Scope 3 puts so much of a bearing on it. And then with the coming onset of the IFRS standard 2, companies are supposed to move beyond just scope 1, scope 2, and then really delve deep into scope 3 emissions reporting. I've seen a couple of tools and then frameworks that have been developed. Recently I've gotten my hands on even an AI-powered and AI-enabled scope 3 emissions tracker, which I believe it's as much as possible being developed to help to ease that burden because of the complexities of that one. The targets are important, of course, because companies would always use them to show that they are trying or what they are trying to achieve, whether the targets are realistic, because once you have a track and target, you are able to determine whether you are in compliance or otherwise. So I believe that the next slide talks about the scenario analysis. Yes, scenario analysis and then climate change. So another important part of IFRS standard 2 is climate resilience and then the scenario analysis. Basically what it is saying is that how resilient is our strategy under different climatic conditions. I have read a couple of articles and seen a lot of publications of companies, mostly in the Western and even some in the Middle East. I know Saudi Aramco, one of the largest oil and gas companies globally, is doing something like this. We have we have things that we call the doomsday bankers. People are saying they are preserving a couple of specimen species and all of that. I have seen some companies also coming out, and within some of these AI-powered. I know in Sweden there's one of the largest AI-powered data center, which is a hybrid underground system to store as much information as possible. And these are well built, and these are basically climate resilience ones because of harsh and extreme weather conditions that could be coming up or are actually ongoing. So the scenario analysis also helps the company to develop such climate resilient frameworks, okay, to help the company to know that, yes, apart from impacting on climate change, the climate change and its attending effects and impacts also replicate onto the business. So as part of the disclosures, companies are expected, okay, to also come up with scenarios. So like the key questions that we have here include: what happens if there's severe flooding disrupts operations? Because this can happen at any time. Like I've seen industrial area at Kaneshi, a lot of businesses, and that's a top industrial zone, and I've seen flood waters all over such places. So you are supposed to, as part of disclosures, come out with some of these mock scenarios, drills, or analysis, and then answer the questions. What if carbon regulations become stricter? What if you are supposed to do a lot of carbon offsetting? You are supposed to go into carbon trading as a business. What are we going to do about it? How is the business model going to operate in a very low or zero? Of course, there is a conversation out there about whether we can do a zero carbon economy, but whichever one, low or zero carbon economy, how the business do? What if the energy costs rise significantly? For example, as we have in Ghana, where there is so much of reliance on power supply from the national grid, very much a lot of attempts into the renewable resources, but still so much of reliance. So companies are expected to come out with scenarios like this, report on their findings, and then help to improve overall operations. Please, if you could move to the next slide. So what are some of the common challenges that businesses face, which the IFRS Standard 2 is seeking to do? So limited climate-related data, it's especially in our part of the world. And I always find that when you are doing some projects, it's always very difficult to come by unless maybe you are going into deeper waters to pick some of these things. So and a lack of technical expertise. The field is evolving with every passing day, but some more expertise and then deeper understanding and knowledge is required. Some weak governance structures. We have a lot of things on paper that are written, but the willpower to get them implemented is always a challenge. Resource constraints, as always, as you would have every problem. Then there's a limited reporting systems as well, because for a long time, the conversations have been about financial reporting. So right now you have climate-related reporting. There is still limited reporting systems, even internally, even by regulators. Besides what I said the bank is doing, there is still some more work that needs to be done that businesses are facing. And then inconsistent supplier data, especially when you want to go into conversations around Scope 3, which relies so much on not direct data gathering by the firm, because as much as possible, if you are tracking the emissions or metrics and targets of your supply chain or suppliers and vendors, it's basically an issue of trust. You are believing that the data they are bringing, you can go with it anyways. If you are not careful, you are reporting on something that is not there. And in most cases, you find a lot of businesses struggle to even translate climate risk into financial impacts. Okay, you may know that there's flooding, there's energy costs, water scarcity are risks, but you do not know exactly how they have a systemic impact on how you quantify your financial implications. So these are some of the things that the Standard 2 would be looking to address, because basically another challenge that most businesses are always facing is ownership, because we need to know that beyond the boardroom, beyond the departmental level, it's a company-wide focus in terms of climate related disclosures so that it will help companies in implementing some of these. So please, you can move to the slide that we were moving to. So we wrap up on the practical steps for businesses. So with all of the conversations that we've had so far, and then implications on businesses and trying to get businesses aligned and prepared, for me, what I've done is that in thinking about it, there are eight strategic areas or starting points for businesses as I have listed them out there. So the first thing, basically to identify our climate-related risks and opportunities. Those examples I cited are very generic to everyone, but as much as possible, they are industry-specific and even company-specific. Then there's regional-specific, and then there's context-specific. Because even if you come to Ghana, the climatic conditions up north, mid-belt, down south, coastal, far left, far right, it's all different, and it varies as much as you move. So companies are expected to identify within your own context, okay, and then strengthen our governance related ones, and then basically improve climate data collection, begin greenhouse gas assessment, develop climate-related metrics and targets, okay, integrate climate into enterprise risk management, build internal awareness and staff capacity, like I said, to garner some more on their competencies, and engage leadership and then board early. So these are practical steps that I believe that as much as possible, companies, firms, and all of us as professionals, as participants, can begin to take as we look forward to the what IFRS Standard 2 is keeping to bring. So in conclusion, for me, I'll say that the key takeaway for me are three things. Basically, climate disclosure has moved beyond a global business expectation. So businesses are expected to increasingly are not only going to be judged by their financial performances, like we have said, but how well they understand and then they manage climate-related risks and opportunities. And the second one for me is that IFRS Standard 2 basically will support businesses in providing a structured framework, okay, for improving transparency, because these are voluntary disclosures anyways. But as much as possible, once you are doing this, you are putting it out there and making yourself accountable to your suppliers, your vendors, patrons, and globally, because you have industry critics, peer reviews, and these will help firms to stand their ground. The third one is that the businesses do not only perform or they are perfecting systems to begin with anyway. The most important thing is to start from somewhere, build capacity, and then we move on. And for me, the final one is that organizations need to understand that in preparation of the IFRS Standard 2, we shouldn't only view it, like I've said a couple of times, as a reporting requirement, because we have had situations where companies are running out to report on things because it is a requirement, okay? But we should see it as we are building a business that is resilient, okay, that is investors have confidence in, with an environmental eye as much as possible, and to make the companies long-term competitive, because once you are out there as green, as highly considerate of the environment, I believe that no investor would not look in your direction, because people are moving away from places where they are putting in monies, and then every single day there's a report on sustainable issues, environment issues, social issues. People are looking in the direction of business modules that have some green thinking around them. So I would say that it is an important session that we are having so far, treating beyond it as a webinar. I believe that we should all, with our takeaways, begin to think how to move, especially our country, where I said that because of where we lie, Ghana is impacted so much by the attending impacts of climate change. So I want to again commend Cleanearth and then all participants and speakers, including myself. Thank you very much. And then I look forward to the QA session and the rest of the sessions.
Thank you, Eugene. We are glad to have you here and to have you speak to us on the IFRS S2. Time is fast spent. We still have some minutes to go, but I'd like us to just take a brief breather. Like I said, the Q&A section is also there. I can see some questions there, but I would wait and hold on to these questions so that our final presenter can present, then we all take the questions. if that's okay with all of us. So we would continue with our last presentation for today. And this would be more on the implementation of both standards, and it would be taken by the Assistant Manager for Green Financing and Sustainability at Exim Bank. And he's in the person of Samuel Kwekukuma. He develops the bank's green finance products and climate finance pipeline and embeds ESG criteria into its lending. I wouldn't say much about this man, but he is a professional and I believe that he has what it takes to even give us the practical steps that we need to take and delve deeper into the steps that even Oscar and the other presenters, Eugene and Ernest, have shared with us. So, Mr. Samuel Kwekukuma, if you're here, kindly unmute and take us through the final presentation of the day.
All right, so good afternoon to everyone. Thank you again for the opportunity to be part of this presentation. My colleagues before me have done a lot of the work today, so as much as possible, we're going to have a very brief conversation, but the goal at the end of the day is to get us to begin to move from our theoretical point of view when it comes to looking at IFRS S1 S2 and seeing how we can be practical about it within our business processes at every level. So can we move on to the next slide? We've had so much understanding around IFRS S1 S2. It gets into understand what S1 means, and we've got a deep dive of S2. So we'll skip this slide because I'm sure that the audience has had so much information from everyone. And we jump to the most important part of this presentation, which is on preparing for this journey. Now, we've outlined 6 very simple steps, and I'm sure that we'll go through them and we can understand them through and through. So, number 1, assess. And I believe that in this bit for businesses around the country who may fall within industries that are not heavily regulated when it comes to sustainability space, not like the banks which have their sustainable banking principles, the climate-related directive, and so on. But for other businesses that operate within the country's space in whatever industry, we believe that you should start by assessing where you are, first of all. I like to use a double materiality assessment in this process, even though IFRS is very single materiality focused. But I'll come back to that on my reason why, because there's some relationships between the two in impact materiality and financial materiality which are critical to any business. Number 2, you govern. So you have to assign ownership. The process of IFRS has to ensure that leadership comes along through the journey. And we have to understand that within our boards, within our leadership of whatever organization, whether it's a sole proprietorship or it's a limited by liability business or it's an NGO, we have to have leadership or board management in line and have to understand where we are going to with regard to sustainability and all of these reporting standards that we have to apply. We have to abide by. Once we have that at the leadership level, it's then the opportunity for us to plan. Now, having a realistic plan, not trying to overdo, knowing what your standards are, what your business is supposed to do, what your business does, and what industry it operates, and what topics are material to you, helps you to put together a roadmap and a budget towards reporting towards that target date. We know that ICAG has its plans for 2027, and we have, as businesses, have the opportunity to be able to make our mistakes and learn as we go. Now, from the planning stage where we have a roadmap, we know that we have to start building. Now, stand up the data, get systems and controls in place, and start measuring what you can measure in the beginning and build on what you can't. And there's so many fancy systems that exist in the last conversation in sustainability that is very expensive. But thankfully, we have wonderful tools that are available that have been developed by organizations like the UNFCCC, where you can actually help to track your scope 1, scope 2 emissions. It's a very simple Excel sheet that any business that is trying to start up can be able to have access to. And for your other standards, you can try and build from Excel, try and build an Excel sheet and collect your data from that point on topics that are material to you. And then as you build on and you get familiar with the systems, then it gives you an opportunity to jump onto a more advanced system and then move on from there. And critical part is reporting. Produce a first disclosure. Use the voluntary window to learn. And as I mentioned earlier on, it is important that businesses take the opportunity now to really understand what they need to be reporting, how it is necessary for their businesses, and how they can use this to identify the risk that can affect their business's bottom line financial position, and the opportunities that they can create that around all of these standards. It's not just reporting. The goal is for us to be able to identify alternative opportunities to raise financial capital and make profits for our businesses at the end of the day. And once we understand where we are and get feedback from our investors and all our customers and everybody, we improve. We add more targets where our customers and our investors want us to be, and run different scenario analysis around scope, and then ensure that you have a plan of a successive cycle where you are improving on a year-on-year or bi-annual basis to ensure that your business is up to date with the standards. Can we move on to the next slide, please? Yes. So in preparing, there are 4 questions I believe we should ask. And I'm sure that, again, my colleagues have done extensive work around the 4 pillars of IFRS S1 S2. Now, the 4 questions that every business has to ask themselves. And again, for me, my big focus is for the SME, MSMEs, and all the other businesses that are not banks who are heavily regulated. You have to be able to ask some of these questions to know where you stand. Number 1, who today is accountable for sustainability risk within your business? Does the board, does leadership, does the manager, as my orga at the top understand it? And is it minuted in all in the meetings? Are we looking at it as something that can affect our business's bottom line, or you're just looking at this as a nice to have? On the risk management side, how do we spot and manage these risks? And is that linked to our existing risk process? If the business has an existing risk process, are these sustainability related risks aligned with our business risk? If they're not, that's a question that you should be answering within your business after this exciting engagement. Into the strategy, which climate and sustainability issues actually affect our business model, cost, and cash flows? For example, if your business is located in Wager right now, this is a very good question to be asking yourself. Once the dam is spilled, how is that going to affect my business existing? Is it going to am I going to be flooded? Am I going to lose customers? It's so hot. Can my customers come to my shop or walk through the sun to come there now? Or because it's so far away from them and the heat levels, we have heat stress going on, we cannot access our business. How do we find ways to be able to minimize this risk or include services that will still help them to access our business? And then once we know all of these things, what can we already measure? And what targets is this? A lot of the time we talk about the sustainability conversation in a very utopian situation where everything seems to be very scientific, and like some of your businesses are already measuring some of these sustainability indicators already. How many people are you employing? What's your gender balance within your business? Are we ensuring that our business reaches the right kind of customers? Are we ensuring that we are not discriminating against some customers and we're giving the opportunity to some others? There's so many different things that we should be looking at. If they are material to us after we've done an assessment, will be relevant to our business. Can we move on to the next slide, please? And now back to my conversation around materiality. Again, we understand that IFRS S1, S2 are largely single materiality focus, the financial materiality conversation. But I believe that to every action, there's an opposite and equal reaction. Inside out impact materiality has an effect on outside in at the end of the day. And we're seeing this conversation, this thing happen now because in the last couple of days, I've actually read an article around the fact that IFRS and GRI are ensuring that their standards align so that reporting is done properly. This is exciting because for small businesses, I have to understand how my business is actually affecting the environment, because the environment would be my investor at the end of the day. And this environment has a social environment, has a physical environment, and all of these things that come back to affect my bottom line at the end of the day. So we understand that IFRS for my investors risk and opportunities, but you can also balance that conversation with a GRI standard, which is very straightforward and helps you to understand what is impact material to your business. And then it can help you to ensure that operations within your business are not affecting the environment around you. It actually improves your customer base, because now we're having two groups of customers that are developed. Some of them that are looking at the impact that your business is having on the environment, and some of them that actually are investing in your business that want to see what can affect, at the end of the day, their financial input into your business. So dealing with both of these customers is critical. And going the line of IFRS S2, we must also ensure that we know how our businesses are affecting the environment too, and everything around us. Can we move on to the next slide, please? So now, once we've been able to go through this materiality assessment, and we've done all our assessments, we know at the management level this person is responsible, we've done all the work that we need to do to a point. Internal systems are critical. I've spoken about that already. We need to build simple, and again, I emphasize on simple and repeatable ways to capture energy, fuel, water, waste, and emissions data. That is baseline environmental side for every business, right? Oh, how much fuel am I buying for my business? How much water are we consuming? How much water are we wasting as a business? How much waste are we making in the business? And how can we use that waste again? Once I'm able to collect this data, I'm able to understand, okay, maybe I can use this waste as an opportunity to make money for myself, because my waste in my business is a raw material for another business. Once you're collecting this data and you are doing this on a consistent basis, and again, a simple and a repeatable way, it gives you an opportunity to be able to track the risks and ensure that you are maximizing the opportunities. Now, for the next bit, once you have data, you have to ensure that there are cross-functional teams in your sustainability agenda. Ladies and gentlemen, the sustainability unit within your building is not the only unit responsible for sustainability. Sustainability is supposed to be a value chain conversation. It has to run through the entire process. So finance, sustainability, operations, and every other unit must work together. Because when it comes to IFRS S1 S2, your investors are looking at exactly how your business, how all of these material topics are affecting your bottom line. And all of these businesses play a critical role to ensuring that some of these risks are minimized and some of these opportunities are maximized, right? And finally, the right size systems. Match tools to your size. Don't try and look at larger industries that may have very complicated tools that you may probably not understand. You pay for a subscription over a period, and then you waste so much money trying to understand the tool. Build systems based on where your business is. There are very efficient systems that exist that help you to learn, that help you to build around your business to ensure that you are measuring the right things. On the IFRS Foundation page, there's so many different courses that your business can take. So you take advantage of all of those ones and ensure that you are building around that. On the third part, you have to ensure, and I've spoken about this slide, so we can move to the next slide. All departments must collaborate. We must ensure that the business as a whole is part of this journey, this IFRS S1 S2 journey, this sustainability journey, so that we were able to properly identify your risk and the opportunities. Now, for the opportunities bit, I believe that these are some of the advantages for you as a business if you're taking these things serious. Number one, you are accessing cheaper and deeper capital. Right. In my career in the sustainability space, you've seen that it's actually easier to work with businesses that have their data ready, that have their risk mitigation plans, they have strategies on how they can manage their ESG related risk. And it helps you to even sometimes reduce interest rates for some businesses because they know what they're about, not just looking at their ability to pay, but their opportunity that they can create around some of these opportunities that come with sustainability and how they are minimizing the risk that come with it. So when you go to banks now, which will do something called an environmental and social risk assessment, if you are not ESG aligned, it will be hard for you to be taking some facilities going forward because the banks would require some of these things from you. And international donors, at the end of the day, also require some of this information around the things that are required under IFRS S1 S2, especially scenario analysis, which is a critical part of S2, and ensuring that you have material topics in S1. Once they know that you know what you're about, they know that once they're giving your funds to you, you will know how you're going to manage the risks around sustainability risk around these funds and how you can make sure that the funds are put to good use. Access to the export markets. The EU has become sustainability proof. If you are not aligning to standards, especially with IFRS S1 S2, and you're not just reporting on them and ticking a box, but integrating it into your business value chain, it will be hard for you to do business with some of these countries in the EU. There's a real cost saving in being able to track some of this information. For some of your businesses, you are paying some electricity bills that you are not, I'm paying electricity bill. But once you start tracking the information, you find that maybe there are some things that you are doing that are wasting power. Or we are wasting water by doing this. So we can improve our process at the end of the day to ensure that our business process is efficient. Operational cost goes down, profitability goes up, investors are happy. Genuine resilience. In a scenario analysis, and there are so many tools, including the climate risk service tool called the CERO, which helps you to do a climate risk analysis. That's scenario analysis. That helps you to ensure that I know what climate risk can affect my business from this period to maybe 2100 or 2050. It gives you the opportunity to be able to plan into the future. Businesses need to be able to do that. And if you have the right tools to run the right scenario analysis, it gives you the opportunity to be able to be ahead of the game. And one of the speakers mentioned that there are so many different AI tools that exist. So it's your chance to be able to learn. Go out there, find the right tools, play around with them, and understand how they work, see how it benefits your business, and then ensure that you can integrate that without really breaking the bank for your business. And the most important thing, investor confidence and first mover advantage. Once you're making the move, you are ahead of the game already. Because in the times when all the businesses are now going to try to pay so much money to be able to align because there's so many different fines that are coming their way, you're already ahead of the game. You're not paying all of that money. You're not always tense because your annual report doesn't have the right information. You've built the systems that are credible and are right for your business. And the investors, when they see this, are confident. Can we move on to the next slide, please? I've explained all of this, so you can move on to the next slide. Next slide, please. Now, to summarize everything I've spoken about, number one, preparation is a journey. And we've given these 6 steps for you to be able to go through. Assess where you stand. Ensure that your governance structure is in place with regard to understanding what sustainability is and integrating it into your business. Plan a roadmap that is relevant. Build the right systems. Report so that your investors and your customers know where you stand and improve on their feedback. Data and process come first. Data is critical. It is very, very critical in this process. When you lie about information in your reporting, and you may not have a problem with it now, years will come by when they do assurance audits of your papers. And when they find out there are issues with your reports, your investors may lose confidence in you. So now the question is, what else are you lying about? So ensure that you are putting the right systems in place and you are consistently measuring what you need to measure. It's a team sport. The entire business is a sustainability unit. Everybody has to be part, from the board level oversight all the way to everybody. Every single person as part of the business. Every cleaner should know why they need to segregate the waste. Every person in the building knows why when I'm giving a credit, when I'm doing business with these people, maybe when they take the product, it may cause this problem. So I need to find a way of educating the businesses to ensure that they manage the problem that may come as a result of my business existing. Adoption is an investment. Do not look at it as a cost to your businesses. Look at it as an investment for everybody within your businesses, because when you invest now, you will reap what you sow. Ladies and gentlemen, it is important that we understand this. The investment in sustainability now is not a loss to your business. It's an investment for future profitability. And finally, the relief that we have, as I've spoken about the fact that we have the opportunities to make the mistakes now, make our life easier. We can start, because we have till 2027 to start reporting. We can ensure that we are putting everything in place. We have a voluntary window now that can give us opportunity to learn, make our mistakes, and grow through them. And most importantly, helping our business to identify the sustainability risks and the sustainability opportunities that are related to your business and your industry. Thank you very much for listening, and we hope we all have a wonderful rest of the program.
Thank you very much, Samuel. This has been an insightful session. I believe would all agree that all presenters have really done justice to the topics that they tackled. And so I believe we all have questions. And so would open the floor for questions. At this point, my colleague Jifa Tometi, our ENS associate, will take the floor, and we may start with the questions in the Q&A side and then open floors for questions. Just put up your hands and we'll call you.
Great. Thank you so much, Gerald. Thank you to the speakers. Indeed, it has been an insightful conversation. We have some few questions in the chat box, the Q&A chat box, so I would go straight to that. But again, if you have a question, you can raise your hand, we'll mention your name and mute, and then you can ask your question. So there's a question here which says, how should investment committees at investment companies and pension funds start to look at S2 as part of their decision frameworks? If Eugene can please answer that question for us. It says, how should investment committees at investment companies and pension funds start to look at S2 as part of their decision framework? If Eugene can hear me, he can.
I can hear you. Can you hear me?
Yes, we can hear you. Thank you.
Good. So basically, for investors, okay, the S2 would basically supposed to help translate climate issues into financial risk and opportunity. So when assessing a company, okay, so we are talking about an investment company. So when assessing a company, the investment firm should begin asking the question, one, how exposed is that company or the intended company to transition risks, okay, such as carbon regulations, changing markets, technological shifts, or even reputational pressures? And most importantly, you should ask your question, has management quantified these risks in a way that can affect revenue, okay, cost, liabilities, insurance, financing, and all of that? So from a practical investment framework point of view, I'll suggest 4 starting points. One, the first thing, I think we've mentioned that, and the last speaker also said the same thing. It's a starting point. One, let's integrate climate risk screening into due diligence before investment decisions are made. Most of the times, the risk factors are coming up because we are looking at them through the lens of aftermath. But for us, we are saying that integrating climate risk screening into due diligence is a starting point. And secondly, we have to assess governance. So does the board understand that climate is a risk, and how accountable is management to the board in relation to that? The third one, I would say, basically, let's review the company's emissions profile, especially scope 1 and scope 2. Like I said, scope 3 is very difficult to quantify. It's something that people are wrapping their heads around. But like I said, emerging technologies and emerging supports is making it a bit easier. Okay, and fourth and finally, the scenario analysis, like I said, to test whether the company's business model remains resilient under stricter regulations. Companies and financing instruments are absorbing or taking up climate-related disclosures. So if we have instances like higher energy costs, extreme weather events, how is it supposed to help the investor and then consumer have expectations. So these are some of the 4 key points. I initially noted this down in anticipation of a question like this, because I was thinking around that. So I believe that I don't want to go too much into it so that we will offer any of the other speakers an opportunity to address it. But this is the point of view from the investor profile. Yeah, thank you.
Okay, thank you so much, Eugene. I hope your question was answered. Another question here says that how is the IFRS S1 collaborates with the existing national sustainability disclosure guidelines? For example, the Ghana Stock Exchange sustainability guidelines for listed companies. If Ernest can help us with this question.
Yes, so
yes.
The IFRS S1 has come to be an international standard. And just as we have other standards, once we have any country, we have the country-specific issues. The Ghana Stock Exchange has its own standard when it comes to sustainability issues. Likewise, Bank of Ghana also has the sustainable banking principles that needs to be applied by banks. So basically, for every organization or entity, it is advised that you take your time to go through the country-specific needs, then you align your specific needs to the international standards. These standards, which are country-specific, have been streamlined to meet our local content. That is why it is very necessary to know what is in there so that you can align with the provisions of the IFRS S1.
Okay, thank you. Thank you so much, Ernest, for that. There's an interesting question that says that is sustainability reports required by Ghana law? I would let someone answer that question for us. Someone is asking if sustainability reports is required by Ghana law.
Hi, so there was a communique by ICAG that as part of regular financial reporting, IFRS S1 S2 would be included in reporting at some point. We have this year as voluntary, and we have next year to start reporting properly. For businesses now, I think that we should look beyond whether it is compulsory, because for me, I believe that the point that the minute we start thinking about it from that perspective, we will do it because we have to do it, not because we need to. Think about your business. Think about your reports that you put out as your interview application to some embassy. You will not be there for them to really ask you some of the questions that they need to ask you. It's a report that will give you the opportunity for them to know what you're about, right? And a lot of the investors now are looking beyond your CSR reports, your CSR posts that you put up on your pages, on your social media accounts, and all of that. We're going beyond that to look at how are you managing the risks that come with all of these ESG-related activities, especially climate risk around your business, and what kind of opportunities they can get from your business at the end of the day. So even though ICAG has put that out, I think that, again, we should stop looking at it from that perspective. It's an opportunity for your business to be seen, because now sustainability is a critical part of everything that you do. You get ESG reports from every fund you take from any donor now. So just because you want your business to improve and you want to put yourself out there, and in the future want to import or export some of your products and your services to other jurisdictions, start reporting now, and let's look beyond the conversation of whether it is compulsory now, even if it is because ICAG just put it out, and look at it from the strategic point where my business can grow from this perspective. Thank you.
Thank you. Thank you so much, Samuel. And this question was for Oscar. It says that who is accountable for sustainability risks? Board, leadership, or management? A follow-up is, how do we spot and manage sustainability risks? And are they linked to our existing risk processes? So basically, who is responsible for sustainability risks? Is it the board, leadership, or management? And how do we spot and manage sustainability risks? And are they linked to our existing risk processes? If Oscar, you can help us with that. Thank you. Oscar, are you on the call? If Oscar cannot hear us, I will just throw it to Eugene.
Okay, let me okay.
Yes, sure. Go ahead.
Yes, so basically it is the board's responsibility. In my presentation, I made mention of it, that it is always the board's responsibility to take charge of sustainability related issues. And just as it is, the various boards work through committees. So I equally made mention to the corporate governance code, indicating that the best committee to handle this, from my opinion, is always the risk committee under the board, to handle sustainability issues, to identify sustainability risks and opportunities so that they can address those issues to the board. And these committees would have to relay their expectations to management. For us, management goes ahead to give the various managers and the downlines their broken down expectations. That is departmental basis, expectation from various departments, as well as expectations from the entire organization, so that it transcends down to, as our brother said, to even the cleaner, for everyone within the organization space to know how responsible we all should be towards the environment and society. So once we take up these responsibilities, then equally whatever finances have been invested into any sustainable activity shall be reported on. Likewise, because we have the S2, which looks at the climate disclosures, if we have anything, especially related to the scope 3 emissions and other things, those issues equally need to be put together, because all these are sustainability issues that need to be reported on by the to the board for them to take decisions.
Thank you so much, Oscar. I don't see anyone raise their hands from the participants. Is it that our questions are in the Q&A session? If you have any questions, you can still go ahead and raise your hand. We have about just 5 minutes to go on the Q&A side of things. So we have another question here, which says, how is climate change going to influence organizations' long-term business model in terms of this particular investment, or in terms of a particular investment, and what investment decisions can be taken to mitigate risks or protect the business? I would let Eugene answer this question.
All right. Thank you very much, Jifa, for the question.
Okay.
So for me, I think it's I saw this question a couple of minutes ago, and it's an interesting one. This is an exact type of question that IFRS Standard 2 wants investors, okay, and businesses to ask before committing capital, okay, because climate change can influence the long-term business model and investment. Basically, I think in 2 ways. Okay, so the first thing, through the fiscal risks, like we said. Okay, so for example, flooding, heat, and all of that. These can affect the operational cost, okay, asset performance, even insurance premiums and productivity, and as much as possible, even the useful life of an investment. And second, through the transition risk, so such as, sorry, excuse me, like I said earlier, the climate regulations, carbon pricing, and all of that. So these are the 2 main areas, okay, that for the long-term business model can be affected. So the question is, before making or continuing with any investment, an organization should basically ask, 1, will the asset or the business still be viable under future climatic conditions? Like I said, like some of the things that people are doing lately with the climate or the doomsday vault, okay, keeping things in seeding, because we are saying that maybe the next 50 years we may not be here, and yada, 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 okay. So, and will the costs increase also because of energy, insurance, or compliance requirements? Okay, so in terms of investment decisions, a company can protect itself, okay, by choosing climate resilient locations, okay, investing also in flood protection or water efficiency, okay, adopting, energy efficient equipment, and then building some climate risk into capital budgeting and project appraisal. I've seen, a couple of companies who are doing this lately. So basically, in attempting to improve insurance cover, they build climate risk into capital budgeting and even the project appraisal phase. So for any high emission investment, the company should also strategically assess whether cleaner technologies or transition pathways are available. So like I said, without attempting to belabor, Standard 2 is not saying businesses should avoid climate exposed investments. I don't believe that is the conversation, but it is actually to quantify any potential financial impacts and then make informed decisions. And if it has to be about offsetting and then redirecting capital to more resilient and future fit opportunities, that's basically the line to which the company should go. Thank you.
Thank you. Thank you so much. Thank you so much, Eugene, for that. I'll take 2 more questions and then we would have to wrap up because I think time is fast spent. So this question is for Ernest. What climate and sustainability issues affect our business models, cost and cash flow? I think this is a very broad question, but if you can summarize for us. Yes. Ernest, you can kindly go ahead.
The question is very broad. I don't know. I see Echo stand up. It looks like Echo wants to comment on that.
I think Echo has a question to answer, but you go ahead and then we'll let Echo come in when you're done.
Yeah, so please repeat the question for me. I want to break it down because it looks too broad for me. Break it down for me.
So the question is, what climate and sustainability issues affect our business model, cost and cash flow?
So for climate and sustainability issues, it depends on the industry, let me say so. It depends on the industry. And when you take an industry like the mining sector, we have climate issues which are categorized under the environmental activities. And mostly when it comes to their climate issues, we can talk about the emissions they excrete into the atmosphere. We can equally talk about their effect on water. We can talk about deforestation issues, which equally leads to global warming and other climate relevant activities they undertake, which actually affects the climate as we speak. And so it depends on the sector. And if you look deeply into these standards, it will specifically tell you that not all the issues pertain to all the organizations. So you might feel that, okay, I'm in the banking sector. Probably you might not see something specific you are doing which relates to the climate. But when you try to make an outline of your scopes or account for your scope, your emissions, you will see that probably most of the activities you are undertaking will be under scope 3, which is affecting climatic issues or the climate. So basically, let me say, so it depends on the sector in which the organization or the entity operates. And I've cited some examples from the mining sites and even for the financial sector, where if they have to finance activities, they would have to look at what their clients are going to use the funds for, if the activities are indeed affecting or has any better thing for the environment. And so let's leave it as such. Probably my colleagues will have some to add, and know that it depends on the particular industry the entity finds itself in.
Okay, thank you so
Yes,
much. Yes, Samuel.
I just want to add on. So,
okay,
you know that IFRS, the foundation, actually has SASB as part of it now. And the SASB platform actually has, to a starting point, topics that are material to different industries that you can identify from that website. So for businesses that are starting their journey that would, again, have to conduct a materiality assessment at one point, it's a good place to go and look on the SASB website and see, okay, for your business specifically, maybe in the mining sector, what topics are based on the data that you've collected over the last number of years, the Sustainability Accounting Standards Board. What data they've collected over a period helps them to identify some topics that are material and then the metrics that you should be measuring under them. So you can start from there and identify some of these topics from there, but it's important that you conduct a materiality assessment, as my colleague just mentioned, so that you can really identify what is material to your business and how it affects your financial, your investors, and then your profitability at the end of the day. So that's my 2 cents.
Thank you so much, Samuel. Echo, you had a question. Kindly unmute. You can go ahead.
Thank you very much, Ifa, and I appreciate the conversation. Together with other companies, there's always the ambition for us to look at Africa as a broader market. So I'm curious to learn a little bit from Oscar what his thoughts are on what he's seen when it comes to trends in adopting some of these sustainability standards, especially the one under today's conversation, that's the S1 and S2. So just wanted Oscar to throw some light on what he's seen in Kenya and maybe broadly East Africa, what the trends are and what the frameworks look like.
Thank you, Aja. Sorry, I couldn't weigh in earlier. My mic had been muted, but it's okay now. Corporate adoption of these reporting standards has not been a walk in the park, and I'd say that in the context of Kenya because of by and large the separation in departmental responsibility. I mean, yeah, organizations have done their materiality assessments, they have set their sustainability targets. Some of them have been compelled to report by the Capital Markets Authority or the Institute of Certified Accountants. But the disconnect between the finance departments and the so-called ESG departments have put a constraint in just the full organizational adoption of what I'd call these IFRS standards. Okay, so companies opted to go for the standards that would illuminate their material topics far much better, that which would be easy to navigate. And of course, the finance team will just put a rubber stamp on it. This is what the organization is doing. And therefore, you wouldn't find a fully fledged financial team going through the internal ESG reports or updates just to find the linkage between what is it that we are injecting our cash in, what are the returns on investments, and are the risks that we are looking at material to our balance sheets. Most of the time it was, does the business look good on paper? Are we just generating impacts to the environment and to the community so that we have the social license to operate with a consumer base? But now that the Institute of Chartered Public Accountants of Kenya just said that, okay, this is going to be a mandatory return for not only the listed organizations, but even other large organizations and SMEs, so long as you are actively operating in this ecosystem, you are now going to have to declare how these sustainability risks are actually impacting your bottom line. And now everybody now rushes to the ESG teams to look at what is it that you have been doing? How can we link our outputs, our impacts, and our risks with our balance sheet? So I will say the disconnect has been there. It is still there. In fact, right now, lots of businesses, especially the non-listed ones, are grappling to just try and understand where they're going to find that harmony between their finances and their impacts so that it's a seamless transition. So by and large, the positive part of it is that businesses are now going to holistically try to tackle the issues of not only creating impact, but what climate and sustainability represents for their long-term operations, what it represents in terms of what they should put into the socially responsible investments, and just put that on declaration, not as a matter of a publicity stunt or buying that social capital, but one that represents the actual business operation. IFRS, do I think it's going to work strongly for Kenyan businesses? Yes, and of course, there are big companies like Safaricom, you find, who have took the initial steps before it was even made mandatory for them to just try and reconcile their impacts, opportunities, and risks with their finances. And they have just stepped out of their comfort to go help other smaller organizations within their value chain understand the same thing so that they're able to adopt it almost to the same level as they are. So it's something that will work practically well, but there's still a lot of work and education that needs to be done for a number of businesses.
Thank you so much, Oscar, for that. I hope Echo, your question has been answered. Unfortunately, this is the time that we have for the Q&A. So I thank you so much. I would hand over to Gerald to just wrap and close for us. Thank you.
Thank you very much, Shifa. This has been a very interesting session, and thank you all for joining us. I'd like to, like to thank our presenters, Oscar, Ernest, Eugene, and Samuel, for being with us on today, helping us understand what IFRS is all about, IFRS S1 S2, delving deeper with us, and even sharing practical steps with us. Thank you very much. Now we know that it's not just work for the ESG professionals, but these discussions also have to take place in the boardrooms, because we have to try and marry financial decisions with sustainability opportunities and risk as well. Thank you all. We are grateful that you joined us. I just would like you to know that Cleanearth provides services in environmental and sustainability sectors, as well as industrial wastewater solutions and clean energy solutions. And our doors are always open to have discussions, discovery calls, just to ascertain the needs of clients and tailor needed solutions to those needs or challenges. So we provide sustainability reporting services and other services that you may need that in the area of sustainability and environment. So kindly reach out to us on the contacts we have shared on our screen. That's the phone number you see, and our email, sustainability@cleanearthsci.com. And we will be very ready and available to discuss, hear your needs, and tailor solutions to your needs. Thank you once again for joining us for this IFRS S1 S2 session. And we believe that you have everything it takes, or everything you need, to start preparing to report on these standards. Have a blessed day, and it's bye for now.